Good afternoon and welcome to Nature's Returns Investing in Ecosystem Services, a webinar speaker series hosted by the Yale Center for Business and the Environment that addresses the growing importance of ecosystem service valuation and investment. My name is Karina Mahong and I will be your host for this afternoon's discussion titled Water in the West, How Impact Investing Can Help. This webinar is the first in our mini-series on capital flows, catalyzing investments in water resources. This mini-series has been made possible through a partnership with the Conservation Finance Network, a new joint effort to provide robust online resources for conservation finance. Together, we will launch a new CFN website, co-host the Nature's Returns webinar series as we're doing today, and provide coverage of developments across the field. We're pleased to have with us today Ricardo Bayon and Tom Melton of Encourage Capital and Peter Culp of Squire Patton Boggs, who will share findings from the new report, Liquid Assets, Investing for Impact in the Colorado River Basin. This report reflects work by Encourage Capital and Squire Patton Boggs in collaboration with the Walton Family Foundation to identify potential impact investments that could be successfully deployed to finance water resource solutions, generate related environmental benefits, and create a financial return. It outlines 11 promising impact investment strategies that have been grouped into 9 separate investment blueprints. While these blueprints could potentially be deployed in many parts of the West, this investigation has focused on the Colorado River Basin, one of the most water-stressed watersheds in the western United States, and one of the most heavily regulated and developed river systems in the world. Before I hand it off to Ricardo, we would like to remind our listeners that we welcome any questions you might have and will direct them to our speakers at the conclusion of the talk. You can type questions directly to the GoTo chat window. And with that, we welcome Ricardo Bayon, Tom Melton, and Peter Culp to Nature's Returns. Ricardo?
Thank you, Karina. So what we thought we'd do was take you very, very briefly through the work we did in this report on the Colorado River and try and leave as much time for questions. By way of quick introduction, Encourage Capital is the merger of 2 entities. One was Echo Asset Management Partners, which I helped co-found, and the other one is Wolfenson Fund Management. And the idea of Encourage Capital is to come up with investment approaches that help solve critical environmental problems. So Tom and I both work at Encourage, and I'll pass it over very briefly to Peter to introduce Squire Patton Boggs.
Hello, this is Peter Culp. I'm a partner with Squire Patton Boggs based here in Phoenix, where I manage our Western Water Natural Resources practice and have been working pretty extensively over the last 15 or 16 years on water scarcity issues in the Colorado River Basin and have been thrilled to hook up with Encourage Capital in order to produce this report.
Thank you, Peter. So basically the history of this report is that at Encourage we'd begun to look at how you can kind of turn the way impact investment is done on its head. The feeling we felt going into, and part of the reason we created Encourage, was that we felt that the impact investing that was being done out there was sort of coming at it from an asset management perspective, and people were saying, you know, I do real estate investing or I do venture capital investing, and how do I layer impact into those? And at Encourage, what we wanted to do was turn it around and design a firm from the ground up for impact. And what that means is, you know, starting to ask questions of yourself and saying, okay, instead of saying I do real estate, how do I layer an impact? You say, well, what is the impact I want to have? What are the problems I'm trying to solve, and how do you design those solutions? And in that vein, we began to work with Peter and with the Walton Family Foundation around the very particular and sticky problem of the Colorado River Basin. And so we said, okay, well, what are the issues in the Colorado? And we were quite upfront and encouraged that we know little or nothing, or knew little or nothing about the Colorado, and that we needed to be teamed up with an expert like Peter. And there are a few things Peter doesn't know about the Colorado River, so it was a good team. And so what we did was look at the problems of the Colorado and try to come up with, as Karina said, somewhere between 9 and 11 ideas for impact investing in the Colorado that will also help address the serious social, environmental, and other problems of the river. And we've put all of those out there. They have a model, sort of blueprint with a model, with ideas, and they're out in the public domain. The report is going to be printed and launched this week, so you're getting a little bit of a preview of what it looks like. So with that, I'll pass it over to Peter to really talk about what are the issues of the Colorado before Tom and I walk you guys through some of the potential ideas that we've come up with.
Thanks, Ricardo. Yeah, so the map you're looking at is a map of the western United States and the sort of watershed stress that we're seeing. And I think as everybody knows, the western United States is now facing some fairly significant water problems. Of course, California has been getting a lot of press lately, but most of the western United States have been facing some water scarcity problems over the past decade or more as a result of both a combination of sort of current drought conditions, but maybe more importantly, the development of water in the West and sort of long-term overuse of water resources. And those problems are basically projected to get worse going forward. The map you're looking at is a map produced by a series of researchers that is sort of projecting out what water stress in the West is going to look like moving into the future. Basically, green is good, red is bad. And as you can see, the stress in that system is, of course, concentrated in the West and very significantly in a region of the country which corresponds more or less to the outlines of the Colorado River Basin. I'm going to go on to the next one, Ricardo. So this is a map of the Colorado River Basin. It's composed of 7 U.S. states and 2 Mexican states. Utah, Wyoming, Colorado, New Mexico comprise the upper basin of the Colorado River. Nevada, Arizona, and California compose the lower basin, along with Mexico, with the states of Baja California and Sonora. The map sort of shows the hydrologic boundary of the basin, but also a number of areas outside the basin where water is used. Ultimately supports about 40 million people, about 5.5 million acres of irrigated farmland, pretty close on the order of about 20% of U.S. GDP is supported either directly or indirectly by the water produced by the basin. But it's also exhibits some very extreme levels of water variability, where a good year might yield 5 times as much water as a dry year. And as a result of that, there's been significant infrastructure development in the basin to try and control that variability and convert it into a stable water supply that can be used to support agriculture in cities and so forth, which has turned it into pretty much the most heavily regulated river system in the world. We very closely control the water of this system. We can account for virtually every drop and where it goes. And in fact, the river itself has not flowed to the ocean since the 1960s because it is completely consumed by humans before it reaches the ocean. That problem has sort of created one of the sort of fundamental issues of the basin, which is that it allocates the law of the river, which is the legal system we use to regulate it, actually allocates quite a bit more water than actually exists. And that's creating some interesting problems I'll talk about in a second. What that legal system has done is effectively converted that natural basin into this plumbing system that you're seeing on the left side, and with a series of reservoirs and diversions that use and reuse water along its length multiple times. Along the way, that's left behind quite an environmental legacy that is now creating some significant problems for us. We've had a century of fire suppression that has left us with pretty heavily overgrown and very fire-prone forests in which we're seeing catastrophic fires. More than a century of grazing, which has eliminated most of the native natural grasslands and led to the spread of invasives, which changes the hydrologic cycle significantly. We've had dams and diversions that have reduced, and in many cases eliminated a lot of stream flow in the basin and certainly changed its timing, leading to loss of a lot of native riparian ecosystems. And then agriculture in cities are effectively, as I mentioned, using essentially all of the water produced by this system. And in fact, are exporting quite a bit of that water outside the hydrologic boundaries of the basin to cities like Denver, Los Angeles, San Diego that rely on the river, as well as other issues around water quality, soil health. All of those things together have combined to sort of significantly stress the environment of this basin and also change the hydrologic cycle in important ways that are now leading to reduced supplies, even as we are continuing to grow our demand on the basin. Next slide, Ricardo. This is a graph coming out of a recent study conducted by the Bureau of Reclamation called the Colorado River Basin Study, which looked at, among other things, the relationship between supply and demand going into the future. And what you can see from this is that basically as of around 2003, the red line, which represents water use by humans in the basin, sort of intersected that blue line, which is water supply surface water supply produced by the natural systems of this basin. And since around 2003, human use has effectively exceeded that natural supply on a reliable basis. And that is, in fact, projected to get worse as time goes on as a result of increasing demand in the basin. Just accounting for some, just the sort of projected growths in demand, we're expecting to see a shortfall of around 20% within the next few decades. Under some of the worst case scenarios, it's much worse than that, maybe upwards of 50%. And that's without accounting for the very extensive use of groundwater in this basin, which drives that supply-demand relationship even further out of whack. If you go to the next one. One of the interesting features of that overuse is that we are now operating within the lower basin of the Colorado River in a consistent water deficit situation in which we use more water than the system can reliably produce. That's actually been occurring for some time, but it had been had not generated a serious problem because there had been a lot of excess water flowing out of the upper basin states that were not using it. But in light of the drought and continued development in the upper basin, we're no longer seeing those excess flows, which has sort of revealed this deficit for what it is. This is a graph showing the level of Lake Mead, which is the major basin storage reservoir for the lower basin states, the primary source of supply for Arizona, California, and Nevada for Colorado River water. And projecting out into the future what would happen if simply the last 10 years were repeated. As you can see, the lake declines precipitously. As it goes below that red line, shortages are going to be imposed on users in the lower basin. As it approaches the bottom of that graph, those shortages could become potentially quite catastrophic. But what's interesting about that decline is it has very little to do with drought. That is, in fact, the result of this overuse, where we're simply just using more water than the system is producing, irrespective of drought. In fact, the only hydrology in that graph is that little uptick around 2011, 2012, where we actually had a very wet year, and that helped us to bring some reservoir levels back up. But in the absence of that extra water, the lake will reliably decline. And that's generating now some fairly significant risk for water users, particularly in the lower basin. The upper basin faces some similar challenges. Go to the next slide. So fundamentally, what the users in this basin are now facing is a series of pretty significant growing water risks that are moving the system towards what we sort of refer to as a permanent shortage. And those risks now threaten agricultural users, as we've seen examples of what can happen with that in the state of California this past year. Hydropower generation, where we are very close now to the points where both Lakes Mead and Powell could potentially stop producing hydropower for the Western grid. Municipalities who tended to develop later in the basin and therefore under the water rights system that we have that awards water rights to the first, sort of first come, first served basis. Those cities are in threat of losing supply or facing increasing supply uncertainty. And with that sort of attendant, obviously, economic impacts on other industries. But it also, of course, is creating very significant risks for ecosystems and the environment, because those uses tend to not have recognized rights to water. As the system becomes tighter and stress increases, the pressure on the remaining environmental resources in the basin is only increased. That risk is being driven by a whole series of factors, certainly central to that overuse problem that we were talking about. But that is an issue that is only potentially worse in the face of climate change. This basin has experienced very noticeable and well-documented increases in temperature, as well as changes in landscape as a result, we believe, of climate change that are beginning to impact water supply. We are, of course, overusing groundwater, which can impact surface water systems as well. Our legal system creates incentives to use water or face the loss of water rights, even when that may not, in fact, be the most efficient thing to do or the best thing to do. It is built on rigid allocations of water rights that don't necessarily respond well to changes in natural variability. All of that has been driving some very significant changes and conversations on this river system about how it is we're going to manage increasing use in the future. There's been tremendous progress over the last decade with new agreements between the basin states, some new international agreements between the U.S. and Mexico, all of which are trying to focus on how to manage water risk. But at the moment, the interventions that are occurring as a result of that are really only occurring at a fraction of the scale that there potentially need to be in order to manage those issues. And it's really that issue which has sort of led to the focus of our report. Next slide. So fundamentally, those problems are really beginning to develop at a rate and a scale that is really pushing well beyond the ability of our traditional institutions to address. And in many cases, this is happening in places that have a sort of limited ability to sort of pay for solutions through the sort of traditional means. Or they're happening in places where, in a sort of commons environment where, like forest health or grasslands health, where the impacts of the changes that are occurring are distributed across all users, but there's no one necessarily, no specific beneficiary who's in a position to pay for those interventions. As a result of that, there really is a potential for some significant investment value as well as public value to the extent that we can identify investment strategies that get at those issues. Fundamentally, that really is going to be about managing this variability, managing this risk. There will clearly be a need for some reallocation of water supply between those that have it and those that need it in the future, but also, maybe more fundamentally, a need for new kinds of institutions that help us to increase the flexibility of the way we use water in the Colorado River Basin as well as elsewhere in the West, and that really begin to search for solutions that meet the needs, sort of cross-cutting needs of agriculture, cities, and the environment. And that sort of thesis, I think, has been sort of fundamental to the effort we made in this report to identify potential investment strategies. So with that, I will turn it back over to Ricardo and Tom.
Thanks, Peter. So as you can see, if you didn't already know, the situation in the Colorado is very, very dire and only going to get worse. And it's not just about the current drought, and it's not something that will be solved if it rains a bit. This is a systemic problem that needs to be addressed in a systemic manner. And there's all kinds of problems in the system, including the way rights are allocated, the way rights can or cannot be traded in different places, and as Peter sometimes talks about, the fact that there are many different sort of rights regimes in the system. But what we really need to do is manage risk, and given the situation, what can we do? And truly, this report comes out of a feeling that no amount of philanthropy will be able to solve this problem. We need to figure out ways that private capital can come in and play a role in changing the way the system works and in providing some solutions to this huge problem. And as Peter points out, this may be a problem that is really dire and stark and visible in the Colorado, but it's also a problem that many other river systems around the world face. So perhaps if we can go some ways towards solving them in the Colorado, we might be able to do something outside of the Colorado as well. So that was also in the back of our minds as we prepared this report. So what we did was, once we looked at the problems and highlighted all the issues that Peter mentioned, and we should say that our report is going to be out there. It's going to be totally public. We'll be happy to send it to everyone. It's going to be quite long because it goes into these problems in depth, and it also goes into some potential solutions. And this is what we want to get into now. We kind of grouped them into sort of 4 categories. Watershed enhancement, which I think of as the sort of supply of water. Then the use of water in sort of 2 categories: agricultural water use, which happens to be the biggest user of water in the basin, somewhere on the order of 70–80%. Then municipal water use and infrastructure, and then market development. So what we will do is not go into all of those, but try to spend a bit of time on a couple of them that we think are interesting. And on that note, I'll turn it over to Tom.
Sure, thanks, Ricardo. I think one of the key points on this slide, too, to highlight is the strategies that we've selected here, importantly, do not necessarily require policy change. They're also meant to be innovative. And, perhaps for the work that we do, maybe most importantly, they're meant to be profitable. So these are private capital investment-like solutions. And so, we'll walk through an example of them just to give you a 2-second description of each. Under watershed enhancement, forest health treatments is really focusing on preventing catastrophic wildfires by funding prevention treatments for stressed watersheds that experience wildfire. Tamarisk removal and restoration, which is B, focuses on invasive species. Letter C, holistic land management. This is about sustainable ranching, similar to the Savory method. Crop conversion techniques. This is about efficient use of irrigated water rights and the crop type that's using that irrigated water, the way that it's also being delivered. Commodity index dry year option, which is letter E, is really focused on a risk-sharing agreement that pays farmers a market rate for their water in years where they don't, when they don't grow any crops. Under the municipal section, the first one there, system loss paper performance, is essentially focusing on fixing leaky pipes and unmetered connections. Green bond with sustainability conditions is primarily focused on financing green infrastructure solutions at affordable rates for municipalities and stressed watersheds. And then the last 2, market development. The Next Generation Water Trust is focused on utilizing a trust structure that supports an investment channel that's self-funding. So it's re-envisioning the way that water trusts are used, and water storage trading is about a market-based system that allows for the possibility of removing the use it or lose it provisions that exist in the basin, and having a market trading mechanism for that. I think if we go to the next slide, Ricardo, one of the structures that we wanted to walk through to just explain how this works is letter A, the first one that I mentioned on forest health treatments. The idea here is primarily focused on the fact that the U.S. Forest Service spends about $1.5 billion to $2 billion a year on fire suppression. Even over the past 2 years, the U.S. Forest Service has pulled around $1 billion from non-suppression programs into fire suppression, and so there's a very vicious cycle of underfunding fire prevention that leads to larger and more catastrophic wildfires every year. And so this solution is meant to interrupt that cycle and to reduce the high severity wildfires by using funds to pay for prevention that will be paid back through reduced wildfire suppression cost in time. This structure is very similar to the social impact bond structure that many people have heard about. Obviously, this is structured for environmental benefit, but then it also has some innovative concepts to it, specifically related to the repayment structure that make it unique. So, as you can see from the boxes that are here on the screen, the investment vehicle, the LLC, is funded by private investors, and it would establish a contract with a principal payment party, such as the U.S. Forest Service, to pay for services provided by the investment vehicle, which would include forest thinning. So the two payment groups that will come in, the principal payment provider and the secondary interest payment provider, will essentially repay the funds borrowed. You can think of the principal payment provider like the U.S. Forest Service, who pays money every year for suppression. You can think of the secondary or interest payment watershed fund payment provider as someone like a nonprofit NGO who's interested in removing risk in the watershed, or maybe a water utility who receives a certain amount of water every year for its rate base in the area. As I mentioned before, the funds that come into the investment vehicle will then be paid out to contractors who will essentially do the forest treatment processes, which in this case would be thinning. The payments that go to the contractors to actually do the thinning in the watershed have to be verified by an evaluator, and this third-party evaluator will look to see that not only have the thinning practices taken place, but also the effectiveness of those thinning practices. And I think what's important here from a water standpoint is not only do these thinning practices reduce the risk of high severity wildfire, but there's also the potential for increased stream flow from the watershed, in some cases upwards to 20%, and the water quality would also be much higher to the extent these treatments take place. We could flip to so this is the result. You can flip all the way, Ricardo. This is the result of the actual thinning that takes place and the water yield benefits from the watershed when the structure takes place. Upon success, the last few arrows will come up, which would be the repayment of the principal to the investment vehicle as funded by the private investor, as well as some form of interest payment from the watershed fund to the private investor. And what's innovative here, again, is the fact that you're really breaking down the structure, and it is pay for performance, but it's based on not just the ultimate success of the forest thinning practices, but also over time potential increased stream flow as well as reduced risk from that watershed, and that'll generally be paid by the secondary or interest payment provider through the watershed fund.
Yeah, I would just add here that as Tom said, the Forest Service is in a vicious cycle where it's essentially taking money from fire prevention to fight fires. And what we're trying to do with this structure, in a way, is turn that on its head and borrow from future firefighting to pay for fire prevention. And we've talked to the Forest Service about this, and they're quite keen on seeing how we can do something like this. It's not going to be straightforward or easy, in particular dealing with the contracting issues around the Forest Service. Forest Service has obviously never done a contract like this, and getting a contract like this could actually be quite difficult. But if we manage to crack this nut, there's billions and billions of dollars that the Forest Service spends on firefighting and fire prevention that could be made much more effective. Yeah,
and I think maybe just one other thing to add, this is Peter, was There is a significant interest in the Colorado River Basin, but I think increasingly in other watersheds, in this sort of notion of creating some sort of watershed fund. This has begun to happen in a number of watersheds around the world. Most of the investment structures that we've developed actually do not rely on something like that. This is one of the ones that does. But for relatively, what I think was interesting to me about this research was that what we found was that for relatively small amounts of money, potentially an order of magnitude less than what we have been sort of testing out in the Colorado River Basin through a pilot program where we've been trying to develop some funds to actually pay for sort of watershed level benefits or pay people to use less water in order to benefit system reservoirs. That for substantially less money than we've had to pay through sort of more direct means, something like this could actually help to facilitate for watershed health investments at pretty significant scales, and they help make an investment like this much more workable. So rather than paying several $100s an acre foot to save water through farm conservation, maybe for $10, $20, $30 an acre foot, water users in a basin could help to create sort of watershed health benefits that help improve overall supply.
So we're conscious of trying to finish quickly to get to questions. So we'll move a little bit quickly through the remaining slides. Tom, I don't know if you want to finish off.
No, I just for the benefit of folks who will hold this slide after the presentation, this is meant to be a relative comparison of all the strategies that we came up with in the report, and so you can see these on a scale of measuring the impact, social and environmental impact, as compared to the financial return, and then the size of the bubble is based on the market size of the transaction and volume of transactions. So this gives you a sense of all the various strategies that we came up with and where they sort of fit on an investing or an impact investing landscape.
Yeah, and as you can see, there's a couple of interesting ones there in green, in particular C, which we felt could have a pretty high impact and a pretty high financial return. That one is simply changing the way ranching is done or agricultural crop production in the cases of number D is done, and benefiting from the water savings, but also benefiting from increases in yield and potentially increased value of real estate. So that looks like a pretty traditional either ranching or agricultural fund with a water kicker. And while trading of water rights and the monetization of saved water is not possible everywhere in the Colorado Basin, it is possible in some places. So focusing those activities in places where that is possible would be key. And also just a word on the impact. As Peter mentioned, every drop of water in the Colorado is used multiple times before it even hits Mexico, let alone the ocean if it ever reaches it. So it's not quite as easy as just saving water, because if you use less water as an agricultural producer, there's chances are somebody is relying on your outflows to do something with that water. So there's always unintended consequences. And so in doing this, we've always tried to keep an eye on some of those unintended consequences and try to create approaches or ideas that could be financeable and that could have a return for investors. So just to finish off, what we believe is that there is a huge potential for impact investing to play a role in addressing the water issues of the Colorado. I think that as the pressures that Peter outlined so well continue to grow, there's going to be more pressure to create the types of policy changes, to use water differently, to figure out the way to make the rules better. But there's also going to be a tremendous amount of value in moving to more water efficient and better water use systems on the Colorado. And if that is the case, then there's the potential for impact investing to play a key role. I just add that as Tom pointed out, we tried to come up with ideas that do not rely on policy change, So these don't rely on policy change, and in fact, some of them, if the policy changes, so for instance, if trading is allowed, some of the returns on these could actually go up. So I think I'll just leave it at that in the interest of getting as many questions and interaction as possible. Does that sound good, Corinna?
Sounds good. Thank you, Peter, Tom, and Ricardo. We'd like to open up the remainder of our time to questions from our audience. Just a reminder, questions can be shared via the GoToMeeting chat window. We have a number of questions already from the audience. The first comes from Lizzie. Years of fire suppression have created unhealthy forests that are less diverse and susceptible to catastrophic wildfire. To what extent does the financial model in corporate business management practices address these best management practices? No, sorry. To what extent does the financial model incorporate best management practices?
Well, I mean, I think that the idea of this that particular fire suppression bond is to bring forward the payments to allow payment to happen to do the best management practices. We wouldn't design what those best management practices are. We'd work closely with the forest managers and the experts to figure out what they are. But the problem is, even if we knew what they were, or even though we know what many of them are, I should say, the Forest Service isn't able to pay for them just because, as we said, every year that it sets aside money to prevent wildfires and to do those best management practices, the wildfire season gets out of control and they end up having to steal money or borrow money from the fire prevention budgets to pay for fire suppression and firefighting. And of course, that ends up in a vicious cycle where, guess what? The next year, there are more fires. And as you guys know, this year has been one of the worst fire seasons in living memory. Well, it seems every year is the worst fire season in living memory. And so how do we address this problem? As you said, part of the problem is that we've essentially prevented all fires, and these systems, these ecological systems, were effectively evolved to deal with lots of small fires, and that's the way they prevented the large fires. And since we've gotten rid of all those small fires, we're getting all of the big fires. So the question is, how do you have money in hand to actually do the thinning and the best management practices to keep the fuels off the land? And that's what we were trying to solve for here.
Another follow-up question from Andrew is, have you quantified the impact of, for example, forest thinning in terms of dollar values of firefighting saved or cubic feet of water increased?
This was a relatively quick and dirty study, so we didn't get into all those levels of detail. What I should say is that in our research, we did come across a lot of the good research that others are doing, including Nature Conservancy and others. And in some cases, so for instance, the Nature Conservancy has shown that in some watersheds, thinning has led to 20% more water flows in the basin as opposed to not thinning. So it depends on the basin and on the system. To get an exact number is kind of difficult. But what we can say is that it looks like in most of these systems, thinning will lead to increased water flows in the river systems. How much in terms of acre feet, we haven't quantified, although that's something that people could do. In terms of the benefits on fire, I think the Forest Service has some ideas of what would happen. And again, TNC has done a number of studies, in particular in California, where they showed that the dollar spent in fire prevention can actually lead to huge savings in firefighting. So there are some studies out there. It wasn't the role we were playing. The role we were playing was looking at some of those studies and trying to say, is there a way for private capital to come in? And what that means is there a way to provide a return for investors for doing the sorts of things that need to be done in the basin to help solve the water problems?
Great. We have two questions with regard to the agricultural strategies. The first is from Scott, who's asking if you can provide more details on the opportunities presented by the agriculture water use blueprints. And Megan, who builds on that question with what are the primary sources of returns and what are the primary cash flow drivers?
Tom, you want to take that one?
Sure. The first one was specifics on, was it on the regions or?
The agricultural strategies. So
yeah, I think in looking at the agricultural strategies and specifically crop conversion, the premise is that you're looking for ways to continue agricultural output in these areas. So you're not buying and drying land. So you want to find ways to finance the conversion and finance the use of ag lands to stay in agriculture without reducing the current yield from that acreage. And so the work that we're looking at doing is, crop switching maybe from, say, a very low value, high water use crop into a low water use, high value specialty crop. In a way that the farmer is not disadvantaged by switching to this other crop, but then also upgrading the irrigation infrastructure in certain areas so that you have more efficient on-farm irrigation networks that allow you to really, I would say, conserve that water that you've saved. So you can save water, but to the extent it's not necessarily done on-farm, it's not transferable, and then in certain areas it doesn't even belong to you. So you have to kind of work within the system of putting all those various things together to make it work. Does that answer the question?
Yeah. Sorry, go ahead.
The one other point, the other blueprint, which I think is sort of interesting, is on the commodity index dry year option, which is
right.
Sort of a different approach. I mean, the crop conversion and efficiency strategy is sort of looking at a way in which you could effectively help improve the use of water in agriculture while keeping farms in production and potentially even improving sort of farm returns while saving some water. Sort of as a byproduct of those activities, you could monetize that water as well, but trying to get away from a strategy where what you're really just doing is sort of buying up agriculture and shutting it down in order to get at that water value. The commodity indexed version is a sort of an effort, I think, to address the sort of risk sharing element, while conversion and conservation is maybe a way to address supply demand imbalance and shift water from one use to another. There's also a really important need for sort of water sharing between sectors in the context of increasing variation. There's been a structure out there for a long time known as a dry year option, where effectively a user with a very low tolerance for water risk, like a city who can't really necessarily adapt their water use in the event of a drought year, because people there's only so much you can do with conservation, and of course people have trouble significantly changing their water use. You partner with an entity with a high tolerance for water use, like a row crop farmer or an alfalfa farmer or somebody like that, who could potentially turn off their water use without causing significant economic damage. And the city essentially pays that entity to stop using water during dry conditions. The challenge with that arrangement, and it's not, while it's been out there a long time, it's not been widely used, is that there have not been very good ways to distribute those economic and hydrologic risks. And so typically what has happened is that farmers are faced with a really uncertain situation where if they're going to agree in advance that they're going to stop using water, they don't know what they're giving up or being asked to give up in the year that they're going to have to stop using it. They don't know what crop prices are going to be. They don't know what the sort of commodity markets are going to look like that year. And so it's been very difficult to implement them in practice. That structure is actually trying to do a better job of distributing hydrologic and economic risk between cities and farmers, essentially setting up a situation where a city can make a very stable payment, sort of similar to an insurance premium, to an investor who will sort of guarantee the access to a supply during an extremely dry year, while the investor also guarantees a payment to the farmer that's equivalent to whatever they could have earned farming based on market prices that year, potentially plus a premium. And then the investor does the job of sort of spreading that risk out onto the commodities markets through hedging transactions. So it sets up a situation where both sides get what they want. The farmer is sort of guaranteed a good income. The city gets a guaranteed supply at a known price that they can build into a rate.
And I should add that one of the reasons why we tried to focus on something that isn't just buy and dry is that obviously, just removing agriculture has huge political, social, and other implications in this region and is much more difficult politically, whereas if you can maintain some agricultural production while still getting the water benefits, that's the ideal. And also, I think we should say that in terms of environmental impact, it's key to know where you're doing these activities because, as we said, every drop of water is used multiple times. So even if you save it on a farm upstream, it's just getting, it goes downstream and is used by somebody else. But what's important environmentally, or what can be important environmentally, is that flow. Allowing for that flow to essentially feed and provide water to ecosystems can have huge environmental benefits. So all of these things were the sorts of things we were trying to take into account in producing these strategies.
Great. A question from Mary. What is the general rate of return anticipated for these instruments, and what range of returns do impact investors expect in order to invest in this sector?
That's I guess John F. Kennedy would have answered that question by saying, that's a very good question. Next question, please. No, I mean, I think that it's a bit of a how long is a piece of string question because it depends on where you do these things and how you do these things. All of that will impact the rates of return. We've produced some very kind of call them notional models for each of these strategies. Showing a range of returns from the low single digits to the mid double digits or so. But that is just in theory. Now getting into the practice is where it becomes much, much harder. I think it was Yogi Berra who said, in theory, there's no difference between theory and practice, but in practice there is. Well, here's an example of that actually applying. In terms of what the impact investors will expect, it also varies widely. I mean, we've seen impact investors who are happy with low single-digit returns if they believe they're getting a significant impact, and we've seen others say, no, I want mid double digits or higher because we believe it's possible. And all the types of impact investments are very, very different. And all the types of impact investors are very, very different. We've even seen some of them say, look, we're happy with just getting our principal back if we have a huge impact. But that is not the norm. That is the exception rather than the rule. I'd say that the rule is, they want somewhere around market-based returns, and they still want the impact. So they want it all. They want their cake and they eat it too. But I think there's also a huge misunderstanding in the sector. There's this belief that in order to get returns, you will give up impact. And I think there are investments where that is the case, but there are also investments where that is not necessarily the case, where actually getting the impact and getting the return are the same thing. And there are cases where the greater impact you have, the less return you expect, or vice versa. So it's hard to generalize across the space. I'll let you peruse the models once you see the report, and then we can talk about whether you think we're we've done a good job or not, but they all vary highly. And as you saw in that bubble chart before, we've kind of gotten some notions of what we think the returns will be, and tried to plot them out in this kind of way here, where some of the higher return ones are being driven by kind of agricultural yield increases as well as land value increases, and then some of the others are producing less return but potentially higher impact. So.
A question.
It's worth noting too that there's a number of different structures in the strategies that we've proposed, and that obviously can change your risk return profile. So finding ways to bring current yield or repayment to the investor sooner obviously increases your financial return. But the idea is really showing all different structures to potential investors and seeing which ones work for them and then which ones work for the stakeholders. So there's a lot of different ways to structure them as well.
Yeah, and we haven't even begun the negotiations with the, take the fire bond one that we talked about. That's going to be a negotiation between, say, the Forest Service and the investor. What's the Forest Service willing to pay? What's the investor willing to take? And, we haven't begun that negotiation. So we've put some numbers in there as placeholders, but we'll see.
Well, one thing maybe just to add there, and then move on to another question, but I think is to note that one of the places where I think there is actually, and particularly in water, an opportunity for impact investment that is a bit unique compared to private investment is the fact that you are having those positive impacts may in fact make, in some ways, an investment easier to do than if it was a purely commercial transaction. There's certainly a lot of interest developing in sort of private, sort of more direct private investment in water, and we've seen over the last decade the entry of a lot of private capital into water, sort of looking at the sort of fact of water scarcity and this increasing risk, and also this huge price disparities that tend to exist between what farmers pay for water and what cities are willing to pay. And folks are getting into that thinking they can essentially engage in arbitrage and buy low and sell high. In reality, the legal system makes sort of straight off water transactions fairly difficult to accomplish, which is in many ways why there are such significant price disparities out there, because it's very difficult to move water from one place to another. But one of the easiest ways to do that is, in fact, to demonstrate that there are, in fact, benefits, environmental, public, and otherwise, associated with those transactions. So in that sense, that's a place where, in some ways, having your cake and eating it too is actually potentially possible for the impact investor, because designing a investment that is going to affirmatively generate a set of public benefits, create benefits for the farm community, say in the conversion scenario, by producing better yields, conserving water, maybe even helping with the transition of farmland from an aging farm population to a younger generation of farmers that want to enter the market, as well as generating some environmental benefits in terms of stream flow. That actually can become a pretty convincing case for why a transfer should be allowed to take place, as opposed to, I bought some water cheap and I want to now dry out a bunch of farmland, wreck the local community, and send it to, say, Los Angeles.
Another broader question from Andrew and Lee is that in the near term, they're asking in the near term, which model is the most established and has the best proven track record? And what do you foresee are the key barriers towards implementing these projects and replicating them to scale?
Well, I mean, I think some of them have not even been, implemented and therefore have no track record. And so we're facing the situation of essentially bushwhacking and trying to get these things done where they have never been done before. I would say to answer your question, pretty much the ag strategies are, I would say, the closest to something that has already been done and that is being done out there. So, there are ag investors and ag real estate investors that do go out there and they do, buy land, change land, and base their returns on either increased yield or, increases in the value of the land itself. And so that exists, that's out there. What we're talking about doing here is actually adding a kind of water benefits kicker to that kind of strategy. So I would say that is one of the ones that I think is most like what's out there. It doesn't mean it's the most doable. It doesn't mean it's the best. It just is more like what's already out there. I would say the system loss strategy, which relies on fixing leaky pipes, it's relatively straightforward. It just adds the creation of a type of LLC and a pay-for-performance structure to it. Again, pretty straightforward, pretty doable. Each of them have their own separate barriers. So, for instance, in the fire bond, one of the barriers is contracting. In the agricultural water use, one of the barriers may be how do you actually monetize the water savings. And they each have very, very different barriers, so it's kind of hard to answer that question with one answer. But we believe all of them are doable. Some may actually be harder than others, and in fact, after we present this publicly at Encourage and working with Peter, we're going to be looking at how do we actually pick one or two of these and try and implement them through Encourage.
Yeah, I think maybe on that latter point, I think they're all doable. Not all of them, as I think Ricardo mentioned earlier, are necessarily doable everywhere. We tried to identify strategies that could potentially be undertaken within sort of existing regulatory constraints or with very modest sort of changes somewhere in the basin, not necessarily everywhere. But for example, the fire bond, the challenge is contracting at the federal level, but it may be possible to implement on a private or state level much more quickly. So in some cases, there's a sort of immediate opportunity, but it may be geographically constrained or jurisdictionally constrained, but it could perhaps help drive the policy changes. We can demonstrate it in some environments, drive some policy changes that would make it easier to implement on a broader scale. The one other tool that I think we do have some great examples of already is actually on the market development side in the water storage trading. That's actually well, not widely used in the United States. There are some excellent examples of the use of markets to assist with water management in places like Chile, Australia, also in northern Mexico.
Another broader question that then applies to the wider conservation impact investing space is that many of the investment models presented in the report rely on returns generated by enhanced or restored environmental services provided by different aspects of the watershed. To what degree are these financial models resilient to considerable environmental risks? How do you account for significant variability in these natural systems? And to what degree can you mitigate this risk?
Well, I think I actually am not sure I agree with the premise of the question. I don't think a lot of them do rely on the increased ecosystem service benefits provided by these. The impact of them may rely on that, but the returns, so for instance, again, going back to the agricultural use, the return on that strategy is as much from the yield increases and the value of land as it is from, monetizing the water. So that doesn't rely at all on, to some degree, on the ecosystem benefits. I'd say, in fact, most of them don't rely on the ecosystem benefits, in part because we were trying to design investable tools that were investable in today's environment, so that didn't expect huge policy shifts or policy changes or even markets for ecosystem services that would allow you to monetize those those values. That was kind of our remit. So I would argue most of these don't rely on that, and don't rely on that environmental benefit other than for the impact. Yes, on the impact, we are saying that if you reduce fires, you're going to get some environmental benefit and some water benefit. And there's a lot of good anecdotal and research evidence to suggest that that is correct. But as you point out, it might not be as much as we expected. And one of the interesting things is if you start doing this on a broader level, you get some people interested in measuring and monitoring those impacts. So hopefully it will lead to greater research on what is possible and what can be done.
Great. One last question from Scott, who would like more detail on how private investors should be interacting with owners and operators of agricultural lands to make those water improvements. And are investors mainly interacting indirectly through market transactions, or do you foresee greater involvement on the ground? And the classic economic question, why aren't these models already being done?
There's a variety of ways in which investors are interacting with folks on the ground. I think one of the sort of things that we came to conclusion in this report is that making a lot of these structures work really does rely on taking advantage of the established relationships on the ground that, say, NGOs and others have been building for decades around environmental issues and farm community issues and other things. There's a great deal of suspicion generally in the agricultural community about outside investment. It's not universally true. Certainly, as you get down into the sort of lower basin states where we have very large-scale production agriculture with very sophisticated producers, many of whom are large corporations, that's probably less of the case. There's a lot more comfort with the idea that investors in a sort of distant city may be the source of capital. I think as you move into smaller communities, there is understandable and in many cases very well justified suspicion about outside capital. It's sort of like the only thing scarier than we're the government and we're here to help you is we're Wall Street and we're here to help you. In many cases, I think our conclusion has been that the way that these things will need to be developed will be with support from NGOs, from foundations, from farm community organizations that can sort of help to sort of identify and also identify potential opportunities and use established relationships to sort of build trust around these models. And I think that also is in some part of why we've not seen a great deal of this in the past. The sort of traditional, I think, commercial investment has really looked at these problems as being sort of arm's length market transactions. And in fact, has been a sort of afraid of environments in which what look like arm's length transactions are difficult to accomplish. As a result of that, a lot of the conversation around water and how we're going to facilitate more investment in water has actually focused on how we can improve markets and make water easier to trade and treat it more like a traditional commodity, essentially take a lot of the politics and relationships and cultural values out of the equation. I think from our standpoint, that's actually not the right approach and certainly not necessary. We can develop investments and identify these opportunities within these existing structures in many cases, and in many cases design investments that are actually affirmatively beneficial to the sort of cultural values that people are trying to protect in places like the Colorado River Basin. And in fact, I think even in the sort of more commercial sector, what you're beginning to see is that the most successful private investments are the ones that are done with a great deal of sensitivity and focus on the ground. So, investors that, they come in and they may use outside capital to buy farms, but they make investments in those communities. They get elected to irrigation district boards. They work to find ways to benefit the community as well as themselves. That's an evolving trend, and I think one that will be continued, and certainly probably need to be increased in an impact investing model.
There's also no avenue really for direct deal flow. Having come from a traditional investing background, you have a whole infrastructure that allows for deal development and deal flow that you can tap into, and I think that doesn't necessarily exist yet for some of the strategies that we're proposing here.
Yeah, and I would just add to what Peter said. Surprise, surprise! It's about politics as much as it is about, finance and other things. So, it's all very, very political. And when you get to water, it's sometimes even more political. What was it Mark Twain, Peter, that said, "Whiskey's for drinking and water's for fighting"? Well, there you go.
That might be a great quote to conclude our talk on water in the West, how impact investing can help. What do you think, Ricardo?
Sounds good to me. But we're available. We're happy to make the full report and the executive summary available. So just ping us. I think you have our emails. If not, my email is rbayon@encouragecapital.com. Feel free to ping me. If any future questions, and I'm happy to forward that to Peter as well. So you have any questions for him or for Tom as well.
Well, we would like to thank our three speakers for joining us this afternoon. If you would like to view a recording of this webinar, please visit the Yale Center for Business and the Environment website or subscribe to the Nature's Returns iTunes podcast series. Tune in next Thursday, October 1st, for the second webinar in this series featuring Joe Whitworth of the Freshwater Trust, who will be discussing his new book, Quantified, and its implications on conservation impact investing. This is Karina from the Yale Center for Business and the Environment saying so long from New Haven, Connecticut.